IVM.
What I'll do is probably do a small recap of what has happened in the last 1 year, because that will help us to connect the dots and probably take us to what is our thought process on why we believe so we're at this juncture on macroeconomic environment. So I think exactly around Jan-Feb 2022, central bankers were still in the state of confusion. They were talking about transient inflation and probably economies coming out of the COVID. How the growth would be panning out, and somewhere down the line the thought process about inflation is just supply chain led and probably will control once things open up. The first thing what they do is whatever they introduce in COVID, they unwound it.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and on today's episode, I'm talking debt funds and fixed income strategies with my guest Devang Shah, co-head Fixed Income Axis Mutual Fund. And we'll be talking debt mutual funds, what's happening, outlook on interest rates, inflation, economy, and much more. Devang, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you for inviting.
It's always good to have people from Axis Mutual Fund. I had Siva a long time ago, Ashwin last year, and now you're in the studio. How's it been in debt mutual funds after that? I really like to call it a shock because it came out of nowhere. Last week of March, quarter end, everyone's like just getting into it, budget is over. And then boom, this entire thing on the indexation benefit being taken away. And that was in March, we're in end of August. So it's been probably, almost 6 months.
Right.
How have flows been so far?
So if you ask me, actually, see, if I split the fixed income category, we are close to 15 lakh crores of AUM. In 15 lakh crores of AUM, we have 10 lakh crores of AUM, ballpark, which is all less than 1 year, where investors also used to churn their money quite frequently. So that has actually continued to remain the way it is. It's more onto your liquids, overnights, and the money market funds. It's approximately more than 10 lakh crores. The 2 lakh crores is more like your passive funds. Again, there, if you look across, the AUM which is there has all remained, because whatever is the money which is invested prior to March 31st, people would want to continue with it unless until they see any big shocks, because you are not going to give up your tax efficiencies. And the balance 3 lakh crores was always those kind of short to medium term long bond funds where people used to actively invest, take active interest rate calls, and probably make some additional returns in a downward interest rate cycle. There is where the question arises that what would be the flow and future for fixed income funds. So the 10 lakh crores and the 2 lakh crores actually would be continuing to grow at a reasonable pace. And what we assume is that the short end of the curve is always linked to the banking liquidity. So the banking liquidity, and it is very, very correlated. The more the positive banking liquidity it is, the short end of the curve and up to the 1 year segment, the money market curves continue to see the growth in AUM. We have actually from 1st of April till now probably seen more than 2 lakh crores of AUM growth in the less than one year category. Wow. So it's like 10 lakh crore on the base of March. Today would be more than 12 lakh crores. Wow. The other 3 lakh crores, the passives have continued to remain the way it is. The 3 lakh crores have seen something like a 25-30,000 crores of flows. It's like a 10% kind of a flow increase in AUM. That is greater than 1 year. I think what investors are looking currently is, it is the way the interest rate cycle is going to behave. We all know somewhere down the line that how much ever we speak slightly negative and the markets have been a volatile, Fed is hiking, RBI is sounding a bit hawkish, all that hawkishness keeping aside, we all know that somewhere down the line we are reaching the peak of the interest rate cycle. And hence investors who want to probably lock in rates, I think these are a good ideal time for them to start investing. And that is why, because the thing has actually come along with the time where interest rates have broadly peaked out, we have not seen any kind of impact. In fact, we have continued to see flows. So in greater than 1 year also, I think probably year to date, on a base of 3 lakh crore, we would have probably seen a 8 to 10% growth in AUM.
Not bad. And we'll get into all of that, the specific strategies later in the episode. I want to ask you a top-down question, right? How has retail investing in debt mutual funds evolved, right? Because story has been equity, SIP, equity sahi hai, mutual fund sahi hai, XYZ, ABC. And anyone who's been in the debt markets, I haven't, but you have, would know that globally debt is a far bigger, far more important, far more significant market as such. Of course, it's been institutional more than retail. And I think that's true in India as well. But if we just talk about India, right, in your view, how have retail investors approached debt mutual funds? Has that changed in the last few years? You look at a very long-term perspective.
So I would say it is evolving, but have we been successful as asset managers on fixed income side? I think no. Because even if I look across at the overall kitty on savings, I think a lot of money is still sitting with banks in fixed deposits. A large part of money is going into longer term products like insurance and things like that. And all these are basic fixed income instruments. They invest in back to back in fixed income instruments. So and as I give you the number, if I look across at the divide on the fixed income AUM, which is broadly 15-16 lakh crores of AUM, we would see a large part of it is still institutional. So somewhere down the line, I don't think so. Yes, we have been able to percolate and penetrate so much into the retail minds. But has the investor started to getting evolved and probably start taking those bets on fixed income products? I think yes. I would give probably some more credit to SEBI also here, the regulator here, and how they have categorized the mutual funds into various categories. So today you have a fixed income fund for an overnight investor. If he just wants to park money for a day, you have a category. Similarly, if you want for 3 months, you have a category. If you want for 1 year, you have a category. If you want for 5, 10, 15 years, you have a category of mutual fund, which will probably give you mix with your goals, the right set of solutions for your investments. So if you ask me, I think with SEBI categorization of all these funds, the more penetration of understanding of fixed income funds, we have started evolving. But have we reached anywhere closer to, I think, probably equity funds or other traditional fixed income solutions? I think no. We have still a long way to go.
Yeah, I mean, $2 billion a month, I believe equity SIPs are there. And there's, of course, a lot of tailwind that comes in from provident fund money and elsewhere. What about the way forward? Do you think that it's just this whole shift from FDs that is a driving factor? Or do you think that someone who's actually 25 years old, starting a mutual fund portfolio, should actually be considering debt as part of his asset allocation plans?
So I have always been so I will have my own biases when I'm talking about debt funds. Yeah. But somewhere down the line, I've always believed that you should have your investments as per your age, your goals, and your time investment framework. Okay, so as I think from a debt investor perspective, if I know the risk appetite of the investor and if I know his investment horizon, I think the fixed income investor will have through his journey through a debt mutual fund will have a very, very good experience. So these are the 2 thumb rules which we actually try and explain to our investors while investing in debt mutual funds. But yes, I think depending on age as an asset allocation and over a longer period of time, I'm sure we have all seen a lot of data. If you look across at longer term trends on fixed income and equity, I think there's not significant gap in returns between the 2 asset classes. It is just that at certain point of time, an equity asset class gives you significant higher returns in 1 year, and probably debt is all about compounding over years. So how I look at it is, if you have fixed goals, if you know your investment horizon, and somewhere down the line, depending on your risk appetite, a definite allocation to fixed income starts. The age can be 25, the age can be 35, and it goes on and on. The allocation percentage might keep on changing, but yes, you should have a fixed income fund in your kitty of investments.
Amazing. No? I mean, you just mentioned about how equity and debt mutual funds equity and debt as asset classes, forget mutual funds. That is just a way of getting in there.
Right.
Have actually not really differed that significantly over the really longer term if you consider. I think I remember when Siva was there back in 2018, I think he had made a similar point that if you just peacefully map out the returns over the last 20, 30 years in India, by the way, not globally.
Right.
I don't think the difference is that much.
Sure.
In longer term returns, because I think the underlying story remains the same.
Yeah, so the index returns on debt and equity, if you look at just a composite index, how does it perform over a debt fund over a period of 20-30 years, and a Nifty index, the gap would be under 3%.
Yeah, I mean, and that's really not much. Considering that debt mutual funds, I assume, have low volatility.
Yes.
Yeah. So, okay. Devang, let's look at it in this way. Let's say that someone is actually listening to this podcast for the first time and learning about debt mutual funds for the first time. Okay, at a generic level, what are the 3 or 5 things that you would want to that you would want him to consider while investing in debt mutual funds that he probably doesn't know or probably is getting wrong, and he should know that this is why you should invest in debt mutual funds?
So first and foremost, I think, as I told you, I think there are certain allocation in our investment by design. Okay, that we need certain money for a short span of time. That money always by design stays in a SA account, okay, or somewhere down the line in an FD, and which is very, very passive. somewhere if you understand that you know your time investment, you know somewhere down the line, this is my goal and this is the period for which I need this money and this is my risk appetite. I think, as I told you, SEBI has beautifully done this job of categorizing funds as per various time investment horizons. So depending on his investment horizon and his risk appetite, he can select that fund. So first is knowing your investment horizon. The second important aspect is to understand that fixed income funds also have some associated risks. Okay, it's like every investment which gives you returns have underlying risk. And you in fixed income, the general levers of generating returns or alpha has always been the duration cycle or the credit cycle. And it is the play on duration or the play on accrual. There is a third element also, which is liquidity, but I think it's more into the shorter end of the curve. The major two, I would say, elements which generate alpha or return is duration and interest credit. Yeah. And importantly, it is then important for the investor to understand that where he is investing into. What I generally tell investors is that in India, if you have looked at the last 15 years or so, after we moved from the underdeveloped so-called economy to a developing phase, okay, I'm talking about 2005 onwards, in India, rates don't stay above 8% for long and they don't fall below 5% for long. Okay, and I'll give you the reason for that. If you look across the longer term trajectory in India on inflation, okay, we have not seen inflation significantly going above 6-7%. Because of the higher than 7%, RBI starts getting uncomfortable. Similarly, because the way the structure of the Indian economy is today, we are still dependent on many things on external world. We are linked to we have a huge current account deficit. So pertaining to all those factors, our inflation in India doesn't fall significantly below 5% for long. Yeah. So if your inflation band is 5 to 7, you add 100-125 basis of real rate, your rates in India will be hovering between 6 to 8%. Right. Okay, and hence the theme for us always has been that yes, one thing is if you are an informed investor, if you can understand macro, you understand inflation, then I think probably do a judicious understanding of the macroeconomic cycle and then take a play on duration. Otherwise, the general theme, if you are at 6% in on your yields or accruals on your products on fixed income funds, I think you should be staying in the short end of the curve, because the element of capital gains, the element of generating additional return in India below 6% looks very, very limited, because you're still not moved towards a developed market economy where inflation is 2% and you have significantly lower yields. Vice versa, if you are at 8% or 7.5% and beyond, okay, the general thought process for an investor should be that at this point of time, I should have by design some allocation to fixed income funds. Why? Because these are somewhere down the line the peak of interest rates where you see in every cycle. So you will not lose as an investor any significantly where you're investing in 7.5 and above in fixed income products. So how I advise our clients is that probably, yes, one, you can take a very, very top-down approach of understanding where the inflation is. And currently, if you tell me, a fixed income investor needs to know the macro economic environment to invest in duration funds. So the easier way out is probably look at the interest rate band or the general thought process on interest rates between 6 to 8%. And if you are more closer to 7.5 and 8%, choose your, depending on investment horizon, choose your fixed income product.
Yeah, very interesting. So, the thing is that for a lot of people who are used to equity, these concepts can really go over the head. And I hope that we can, do probably some more episodes just understanding this, because I've often found that people enter with one objective, find out that this is some other product. That I went in expecting capital gains, but nothing happened. This fund is not giving me any returns, probably at the short end of a curve of doing liquid. Or the other way around. I wanted my capital to be safe. So I invested in a GSEC fund or something, and within 1 year, I'm already down 5%.
Right.
Okay.
Right.
Or I wanted to go in some foreign vacation, so I saved up for 6 months and I put it in a credit risk fund.
Right.
And I'm down 2%.
Right.
I don't know who advises these people first of all. Okay. Just a warning out there.
Right.
But I don't know. What's your view on the mistakes that people make?
So I would say, if you follow certain thumb rules in fixed income investments, and I that's why I tell you these are very, very important things, and you have highlighted all the things which are perfectly correct. I think you should not look at past returns and probably invest. So the investors make the mistake is that, okay, if fixed income returns have given double digits, okay, that is the time probably now the cycle is good. That is wrong. Because what has happened is, if the fixed income product has given you a double-digit return, probably a lot of capital gains have happened because of interest rates cut. And at that point of time, we should not take the longer duration products. Yeah. The thought process should be probably now the time is to come out from, the time has started to come closer when you need to move out of these products. Yeah. But investors looking at past returns start allocating money there. So our assessment always has been twofold. One is, as you pointed out, know your investment horizon. If your investment horizon is short-term in nature, don't venture out in long duration funds, because your thought process, it is very difficult to predict where the interest rate cycle will start to peak out, what kind of volatility we'll see in between, because the entire world is now interlinked. How much ever we say that we are decoupled from what happens globally, we are not. If Fed keeps on hiking, we will start seeing some pressure on currency, and we'll start seeing some pressure on RBI indirectly, even though the local macro is good, to be cautious. So first, identify your time investment horizon. If your investment horizon is short, generally stay invested into up to the money market curve. And there you will not see so much of duration volatility. The second aspect is, what is your risk appetite on understanding credit? I think there's a lot of disclosures now being made in fact sheet on riskometer. There's a lot of disclosure being made now on fact sheet on potential risk class. What are you entering into the kind of fund? So if you are a risk averse investor, generally invest in a quality biased product which has a higher percentage of AAA, which are just replica of ESU FDs, because those are generally AAA in nature. So if your risk appetite is very, very conservative, the thought process for you should always be investing in a AAA biased funds, and to be again invest in the short end of the curve. The duration play and the credit play is generally for investors who are tactical in nature, who wants to capture the interest rate cycle, understands the duration of volatility. For them, I think in a simplified format, obviously we can have a detailed discussion on macro about how growth is going, to what is the interest rate view, today how interest rates have peaked out. But I think unless we are moving to a developed market economy, this fundamental thought process of 6 to 8% will help them and have a good investment journey. That closer to 8, you will not lose much on fixed income, even though you invest in a duration product, because above 8, rates will not stay for long. And similarly, below 6, I think you should always be in the short end of the curve, unless and until we are expecting a significant transition of India from a developing market to a developed market zone.
Yeah, wonderful. I mean, I like that you've simplified it in a very general way in that range. And we are going to get into all your outlooks, by the way, so don't worry. Devang, let's pick up from where we ended in the previous half of this episode on more contemporary things. Where is India right now and our market on the macro story? We can start with interest rate, inflation, and then, economic growth. And we'll build on to that as we talk.
Right. What I'll do is probably do a small recap of what has happened in the last 1 year, because that will help us to connect the dots and probably take us to what is our thought process on why we believe so we're at this juncture on macroeconomic environment. So I think exactly around Jan-Feb 2022, central bankers were still in the state of confusion. They were talking about transient inflation and probably economies coming out of the COVID, how the growth would be panning out, and somewhere down the line the thought process about inflation is just supply chain led and probably will control once things open up. What happened is we saw a Russia-Ukraine issue, a war, and that led to significant impact on commodities, supply chains getting disrupted, and we saw a panic reaction from central bankers, which had to come because you could see significant spike in inflation. The first thing what they do is, whatever they introduced in COVID, they unwound it. So you saw unwound of liquidity. They used huge liquidity. They pumped liquidity into the system, and it's common across all central bankers. You pick up Fed, you pick up ECB, you pick up RBI. I think everyone has done the same thing. They had infused liquidity, cut rates in COVID. What they did as a factor when you got this surprise and shock on account of war, you unwound the liquidity and you started hiking rates. I think we have seen the fastest pace of increase in rates in the last 18 months across various central bankers. I think Fed moved from discount to closer to 5.5 now. When you look across at RBI, moved from 335 to 6.5. So you've seen a 300 to 500 basis increase in rates by all central bankers. That has been the last 12-18 months.
In about 12-18 months, yeah.
Yes, from Feb 22 to probably now we are at August 22. 23.
Correct.
Now, when I look across at things beyond, when I see incrementally from here, I would probably cover on 3 aspects. Because a central banker, when they're looking at interest rate cycle, they're focused on where the inflation is, where the growth cycle is, and probably third, the external environment. That is what I think the 3 parameters which RBI also considers. When we see inflation, I think that the story about inflation is, yes, you keep aside the veggie and the food inflation, which keeps on making noise every pre-monsoon and then probably settles post-monsoon. I think keeping aside the vegetable inflation and the cereal food inflation, the inflation trajectory, when I look across the core and which constitutes the major part, not only RBI, which RBI focuses on, even central bank globally focuses on, is all showing a downward trend. So core inflation is hovering now around 5% and will probably go towards 4.5% to 5% band for the next 12 months. I think keeping aside this noise around on tomato prices and onion prices, I think inflation in India will settle close to 5.25% for the full year. At its max, if the monsoon becomes very erratic and we see some increase in food inflation, I think government policies will be significantly at its play and we will start seeing inflation cooling off. With those impact also, we don't see inflation going above 5.5%. We are currently at a repo rate of 6.5%, a 100 basis real rate. I think all the external members also spoke yesterday, the RBI external members, that 100 basis of real rate is a very, very good real rate. And now, when it comes to the growth side, we also need to understand that growth, we are probably nearing the peak of growth cycle. And I will give you 2 reasons for that. One, the entire growth cycle has come because of 2 effects as per me. And one is the strong consumption effect, which came across on one, the pent-up demand pre-COVID. And just during COVID, there was a lot of pent-up demand, which led to the next 12-18 months being good on the consumption cycle. The savings impact, which happened during COVID, because everyone saved a lot and probably wherever we invested into it actually gave us good returns after 12-18 months. So we had a wealth impact also. So savings and wealth impact led to the consumption theme. That is started to fade away. We are not neither having the pent-up demand anymore. The wealth impact is probably dwindling because actually the asset classes now over a 2-year period have not given such good returns.
Correct.
It is just that the COVID and the 12 months hence COVID where they made huge returns. After that, probably there's been a stagnancy or a lower teens, lower single digits or slightly upper teens is where people have started seeing returns. So as per me, I think the wealth impact is probably starting to fade away. The second big reason which contributed to the growth cycle in India was the fiscal impetus which government did. And it is not only India. I think US also, I'm sure you've seen the kind of fiscal deficit they are running across and the fiscal push which everyone is doing. And that's been the case everywhere. It's a monetary and a fiscal play which has helped to come out of COVID and shine on the growth side. India did very, very well because overall the growth impetus when it come across from fiscal side was huge. We believe that these kind of fiscal deficit numbers, like pre-COVID, if you look at the fiscal center plus state put together, used to be close to 3.5% on center, 2.5% on state, close to 6%. At max 6.5%. Today we are running at close to 8.5%. So we start seeing the fiscal started to getting contract or withdrawn. So this fiscal support, once it start getting withdrawn, if you don't see an incremental investment demand coming from the private side, we'll start seeing growth to come off.
Correct.
So our view is when we look across from a next 12-18 months, I think from RBI's perspective, this would be the peak of growth cycle. The other impact would be that exports might also start seeing impact because global cycle or global growth cycle will start seeing some bit of pain. So how I look at things is, you are at the peak of the inflation. Inflation is on a downward trend. When you look at the growth, again you are at the peak of the growth cycle. I think in the near term we can see next 2 quarters being good because before elections we'll see a lot of spending from government. But on a 12-18 month perspective, I think this is the best of the growth cycle in the near term. We will start seeing growth also on a downward trend. These two with a stable external environment. And why stable external environment? I think commodities have remained sideways. Somewhere down the line, the China story has not been coming out great. And the China weakness is very, very strong for the India external side because we get a lot of allocation and money flowing on account of China plus one theory, somewhere down the line, a more stable market, and which is helping us on the external side. So a stable external side, peak of growth, peak of inflation, we believe now the trajectory for rates is lower. Probably, yes, it might take 6 months more for RBI to start cutting rates because they want to weed away this noise on food inflation. They want to see that the trajectory for inflation is lower. don't want to be the first, one of the first central banks to start cutting, and probably too bold to start cutting rates before Fed. But I think the trajectory would be lower. So from a 6-12 month perspective, our macro environment view on interest rates is that the rates are headed lower. In the near term, interest rates might see a bit of range play. They will not see huge volatility. Our view is that yes, monsoons can be erratic, but will it lead to significant spike in inflation where RBI will panic and start hiking rates? I think I will assign a very, very low probability to it. Yeah. So assessing the macro, our view is this is, I would say, the peak of the interest rate cycle.
Yeah, it's very interesting, right? Because, the comprehensive answers that you've given and the very clear logical foundation for that is, this is the transition that happens from one end to from one side to the other. As a central banker, this is a very sensitive turning point.
Yes.
If you're too early, there are consequences. If you're too late, you don't want to be, especially in a country like India. And I think our central governor has got things right, touchwood, so far.
Yeah. They've done a superb job, in fact, if you ask me.
Yeah.
Because they have built up reserves, and at this point of time, what is entirely giving us a position of strength is this external environment. See, this is the year where actually, if you see developed market bond yields, developed market currencies have shown more volatility than India.
Yeah.
And somewhere down the line, we have always been considered a part of the fragile five. Okay, we are no more that part of the fragile five. In fact, year to date, yes, rupee has seen some weakness, but other currencies have significantly sold off more. So I think the government as well as RBI has done a superb job in first coming out of this COVID crisis, managing the external environment, and somewhere down the line overall putting a lid on inflation and not seeing so much of volatility despite we having huge current account deficits.
Yeah, I'll just take a 2-line answer from you, because I just want to get this out of the way, since you've spoken so much about the macro, and I just can't help. Where is the currency in this? In the sense that, we are at 83-ish, I would say. Certain section believes it's too pricey, certain section believes it's too cheap. Wherever you are on that, I don't know where we are. It's not an area that I understand. Any thoughts on that?
See, we are not currency experts, but our understanding is assessing the macro. We would not see significant depreciation of currency from here. So if you ask me, despite we might see some outflows on account of all these reversal of Fed cycle, or probably a risk of trade if US growth significantly slows, even then I don't think so much pain on the currency, because the way RBI has managed the external side, I think they will utilize the FX reserves if we see volatility there. So I think it will be a range to if you give me a level to put across, I think probably a narrow range of 81, 84.
Yeah, I don't think I've seen this stable depreciation for a long time. I remember 20 years ago, or even more than 10 years ago, we used to have like 5% per year depreciation. I think last 3, 4, 5 years have just been 2% per year.
So the thing is, because we got such huge flows and we have actually tried to accumulate them in the time where we are getting, and everyone questioned why is RBI not allowing the currency to appreciate. I think the logic was it's answered this year, because they had to utilize some bit of FX reserves and they've used it on the rainy day. Yeah. So I think if you ask me, what RBI is doing is RBI is trying to probably absorb as much of dollar flows when it comes across, and build up reserves, accumulate reserves, and probably use them to avoid unnecessary volatility. But on a overall macro perspective, we don't expect currency to depreciate much. Appreciation any which is, I don't think so RBI is very keen on. So It will be probably a range of 81 to 84 is what we believe.
Yeah, folks, if you're wondering why I'm talking so much on this, it's something that we don't talk very often on this podcast. And Devang, I'm sure that you've been in this market for a long time. Anybody who was there back in the 2000s would understand how wild this whole thing used to be. Whether it was currency or interest rates, I think that we had the 10-year go from 12% to 5%. From 99 or 90s, late 90s all the way to mid 2000s.
So when all of us were kids, in 1997, my father made an NSC.
Not me at least, but go on, sorry.
So he made an NSC for me, and probably in 6 years, 5 years actually, it doubled. So in 2003, the entire money what he put for me, he put some 10,000, it was 20,000. Okay, so the point I'm trying to put across is that you're right. Fixed income rates in India, and that was the underdeveloped market zone. because we were still developing. The currency was not linked. We were not linked to the external world completely. So the fixed income rates in India there at that point of time were 12, 14, 15%. And they used to double in 5 years. Post 2005, if I look at the era on fixed income, it's always been in this band of like above 8%. It doesn't trade for more than 6-8 months. I'm sure we remember all of us in 2008-9 where the global financial crisis period, where for a time frame bank FD rates had touched 9%.
Oh yeah, of course.
And everyone wanted to have the longest tenure FD at that point of time. Everyone's saying that lock in the rates, and these rates are not going to be easily available. And actually, if you see after that, we have not seen 9% FD rates. So the point I'm trying to put across is that once we have transitioned from that underdeveloped to developing market, we have had these band on rates, and probably for a fixed income investor, if they actually maneuver their investments in this band, where invest it closer to 8 and probably stay in more shorter term cash type of instruments at closer to 5.5-6%, I think they will have a great fixed income investment experience.
Fantastic. Let's go into that in a little bit more depth, in the sense that what are which categories, and you've already said this a lot in the show, but I just want to kind of recap and wind up with this, that what categories look attractive to you now and what might get attractive, say 6 months down the line, 1 year down the line. Let's talk about that.
So see, I always, what I try to specify also, I always look at the investor thought process. Okay, and our thought process is that first focus on what are the type of investors, what do they need from fixed income funds. I think there are 2 or 3 sets of investors. One is that I'm just looking at a parking solution. Give me a parking solution which is very good, gets me better than alternate traditional solutions like a savings account, and probably how do I just temporarily park my money for a shorter term investment horizon. I think the money market category makes a lot of sense for them. In the money market category, you have 3-4 categories. I would say just pick up the money market category and that would sort out the purpose. So liquid and money market category, liquid is up to 90 days and money market category is beyond 90 days. So if you have anything between 3 to 6 months, invest your money in money market funds. If you have investment up to 1 to 3 months, just invest in liquid funds. So this is for the first set of investors who is always looking at a parking solution. Then comes across the investors who are always those traditional fixed income investors who have been investing in regularly in traditional solutions, okay, like corporate FDs and fixed deposits and things like that. And they are looking at mutual funds as a solution or an alternative for them.
Sure.
For them, I always categorically advise 2 sets of funds. One, who is completely risk averse, just invest in a short to corporate debt category. So it's a short-term fund or a corporate debt category fund. These are 2 categories of fund which suits very good and probably the investment profile of a traditional fixed income investor. And the second one is a medium-term kind of a strategy, okay, which is a medium-term category again, which suits well for investors who are looking at that a bit of an extra return over FD. They are still traditional in mindset, don't want too much of volatility, but they want that 25-50 basis additional return over a traditional fixed income solution. And a medium term category over a 3-5 years investment horizon gives them this kind of additional, I think, time. We have seen how we have done some work along a short term index or a medium term index over the last 15-20 years. How does it probably work across as across a traditional fixed income solution? Probably these funds try and give you that 25-50 basis of additional return. So if a fixed income investor is having a traditional mindset and looking for conservative solutions, short to medium term funds are the best solutions. The third category is the category who is the informed category and who wants to take those tactical bets on accrual, on duration. I think dynamic bond funds, and after the tax advantage going across, I think it is more that they're not sensitive to investment for a period of 3 years. They can just take the benefit of the interest rate cycle or the accrual cycle and then probably move out of the fund. So these are those tactical investors who are looking at solutions in fixed income which probably can give them those extra returns. I think for those set of investors, who are informed and who understand both the credit play and the duration play, I think a dynamic bond fund category makes a lot of sense.
Sure.
So these are the three set of investors, and according to the three set of investors, I've probably tried and given you the categories of funds.
So you've gone from 90 to 180 days in the liquids and the
money market
fund for people who want to keep for a short duration. Then you've gone for the traditional fixed income guys who you believe
2 to 3 year investments.
2 to 3 years. Then you go into slightly more medium term, and then you've gone to the up to 5 years, for people who want to.
But those are more tactical. So the investor actually did not stay for 5 years. Okay, that's an investment who is actually taking a pure and interest rate call. He's an informed investor. He understands that, okay, now we believe interest rate cycles are going to get cut, or you will see interest rate cuts of 50, 75, 100 basis, and probably I take those benefits of this interest rate cuts on my return. So for those investors, I think dynamic bond fund makes a lot of sense. So yes, those are funds which are having longer duration. They maneuver the duration depending on the interest rate cycle. Today, most of dynamic bond funds will be running longer durations. But these are those informed investors who can take those tactical calls on fixed income products. So I would probably, depending on the category of investor, which is a parking solution investor, more invest in the shorter term, very, very short term category like liquid money market. A medium term conservative fixed income investor who is looking at those traditional solutions, happy with a traditional investment return. Okay, I think probably short to corporate debt category, and a tactical investor who is an informed person who understands duration and credit play. I think dynamic bond funds.
Lovely. Next question, like I said, was when do the others start looking good to you? Longer term funds, corporate risk, credit risk, G-Secs, anything on those?
So at this point of time, a dynamic bond fund would be actually mimicking a very, very similar to a G-Sec or a long duration fund. So the best part of dynamic bond fund is, and if the fund manager stays true to the name and the category of the fund, they should maneuver the fund depending on an interest rate view. So a dynamic bond fund runs like a long G-Sec fund in a peak of the interest rate cycle, and like a conservative short-term fund at the bottom of the interest rate cycle. So that's the way the play is. So if you ask me, I think an investor who is informed and who wants to play both the cycles, I think dynamic bond fund makes a lot of sense. Gilt funds today, depending on the macro environment, where we believe that it's at the peak of the interest rate cycle, it definitely makes a lot of sense. But yes, the investor needs to be slightly patient because interest rate cuts, as I told you, probably can be 6 months hence. So from here to the next 6 months, it will be a range play, and you see some bit of volatility, as you rightly pointed out, because if your investment goal is 3 months and 6 months, I think gilt fund doesn't make sense. Obviously. If your investment is for the next 12, 18, 24 months, at this juncture, analyzing the macro environment, gilt and long corporate bond funds makes a lot of sense.
Yeah. Okay. We are done, but I have two. One is my standard question. I'll get to that in a bit. Devang, I want to understand two things. Okay, for our listeners again, accrual and duration. These are two very, very important points that anybody who invests even 1 rupee or 100 rupees in debt mutual fund needs to be very clear about. Right. Often people get mixed up between the two, and the conversations I've heard usually people just want to play the peak of the interest cycle because they feel ki chalo peak aa gaya, to let's all just jump in and I'm not sure that that's the right way to do it, but whatever. But I think these two things, and there are a lot of other concepts in debt mutual funds also which are a little bit tough, but whether it is clean price, dirty price, and much more. But if I just look at accrual and duration, because I think this affects the NAV directly, and therefore the value of my investment. Just explain to us on a conceptual basis what do these two mean and why they're important.
So see, duration is very simple. It is actually like, in simple terms, if I am investing in a 1 year product, okay, for the interest rate sensitivity is equivalent to whatever the movement on interest rate happens and for that period of duration for 1 year. So supposedly, if there are interest rate rise of 50-100 basis, if I am invested in a 1 year product, I will see a capital loss of 100 basis. Okay, so 1%. Same thing, if I'm invested in a duration product which is having a 7 year duration, example, like you said, a G-Sec fund, a long G-Sec fund which is having a 7 year, 100 basis increase in rates will give me a capital loss of 100 into 7, that is 700 basis, which is equal to 7%. So the duration is actually, in simple terms, the maturity of the bond okay, which is there, which I reinvest the coupons, I find out the coupon play and everything, and I calculate the duration, but it is actually the interest rate sensitivity. The higher the duration in a interest rate falling cycle will give us higher returns, because you will start getting those benefits of 50-100 basis cut. You multiply it by the duration, that is the capital gain.
Correct.
Over and above the accrual. And vice versa, in an interest rate rising cycle, you will start getting that much of capital loss. So that's the concept of duration. The duration is nothing but the maturity of the bond in simplified terms, where you find the cash flows and you find out the overall what is the play on the overall duration of them.
Yeah.
When it comes across to accrual is the return which by investing in that product you will get. And accrual and duration are not at all similar.
Yes.
Accrual is what you get as a carry or an yield on every investment. And in a year, okay, if there is no interest rate movement, zero basis of movement, supposedly if we just invest in a 1 year CD, certificate of deposit, today the 1 year CD rates are probably hovering around 7.35. If there is no interest rate movement, after a year I get an accrual or a carry or a yield of 7.35. It is as plain vanilla simple. So it is like in FD, the coupon or the interest rate, accrual is exactly the same thing. Okay, and duration is the convexity of with which you multiply the cash flows, you take the longer bond, you will have a higher impact on returns in either side depending on the interest rate view. So duration leads to more of capital gains or losses depending on the interest rate cycle. Accrual is just a basis of addition of income on a daily basis. It's like your daily accrual of return, or in an FD, it's like a coupon which you keep on getting every day.
And guys, if you could just, replay that last 5 minutes, you would learn a lot about fixed income. I just wish that more people knew this. It would help debt mutual funds a lot. Okay, we are done with the show. But my final standard question to all our guests who come in here, who are kind enough to give me their time, any content recommendation, any book that you're reading that you like to share with the viewers, or anything you're watching, anything at all?
See, I had, in my early days, I read about this book of Endgame and the End of Debt Super Cycle. And which was by Jonathan Trepp and John McClellan. It was a very good book which gave a lot of insight about how various central bankers, economies, they printed money and what kind of episodes we have seen in global markets, and probably the learning for central bankers. I found it very interesting, and that helped me a lot in making decisions about how a central banker probably would be thinking at various point of time. So I think that is a book which I always recommend to debt investors. It is obviously it's a boring book, but it is more about how a central banker has faced difficulties in various debt super cycles.
Amazing. Nothing from Bill Gross or L. Arian or anybody of that sort. That's, I love it when someone comes up with a book that, it actually shows that you're reading something that is not, very popular, let's say, because when you say debt, globally, there's just these two guys. Probably Bill Gross more than anybody else.
Yeah. I like reading his books.
I know you do, but I'm just saying that top of mind, the book that came is something that even the end of the debt super cycle.
Yes. End game, the end of the debt super cycle.
Is it the end of the super cycle, do you think? Because
no, they had actually predicted that it would be in this time frame, but it's not happened.
Is what, 40 years now?
Yeah.
Man. And US has gone down to zero. I don't know how many. Anyway, that's a separate discussion, folks. But we've already gone on for long. But that is it. That is a wrap on this episode of Paisa Vaisa. My guest, Devang Shah, co-ed, fixed income, Axis Mutual Fund. Devang, thank you so much for doing this for our listeners.
Thank you for having me.
Really enjoyed the part about, the accrual, dynamic and duration part and everything that you nailed down in such detail for our listeners. Thank you for giving us your time.
Thank you for the opportunity.
IVM